Let us understand how money market works. Now, the word market tells us that it has four characteristics, or four characteristics. It should have a product. So you have the product is money, and then there is demand for the product. So that's the demand for money coming out of people. Um, then there is supply of money, supply of the product, which is controlled by the Fed or the central bank of the country, and then equilibrium in the market, which will give us the price of the product. So there are four features of any market. It will have a product, money. In this case, it will have people who demand money, so people. We have a supply of the product, so supply of money, which is the central bank of the country, and then the price of the money, which is nothing but the interest rate. So just like any other market, we have quantity on horizontal axis. We are talking of quantity of money. So we are talking of quantity of money on horizontal axis, and then price of money, which is price you have to pay to get money. So if I want a loan, I have to pay a price to get that loan. I'll get money, I'll get a loan, but I'll have to pay a price, and that is nothing but the interest or the loan that you have to pay. So loosely speaking, it's the interest rate is the price of money. And so let us think about why do people demand money, right? There are three main reasons why people would want to hold money is precautionary reasons, which is to say, because people don't know what's going to happen in future, because the future is uncertain, they want to keep certain money in their checking account. Transactions, demand for money. At the end of the day, we hold money or we would demand money is because we want to execute a transaction. I want to buy my coffee and I want to drive. I want to put gasoline in my car. And so basically, it's the real GDP denoted by Y, which is driving the transactions demand for money. And then speculative demand for money is when you think about what is the kind of relationship does one think when you think about real interest rate or the interest rate and money demand, right? If interest rates are higher, then I would put the my money in that security bond, say for example, which pays interest rather than hold it in my wallet. So the demand for money will be lower if the interest rates are higher. So interest rate in some sense is the opportunity cost of holding money. So if you hold on to money, you will lose interest rate, right? You won't get interest because you're putting money in your wallet and not putting money at a place where it will give you R, right? So because the opportunity cost, if the opportunity cost of money is higher, then the demand for money is going to be lower, and vice versa. If the opportunity cost of money is higher, then we would want to demand more money, and hence money demand curve will be downward sloping. And of course, this is only one factor which affects money demand, as we just discussed. If one wants to buy more coffee, then they will need more money to hold, which in a broader macro sense, if GDP expands, the demand for money will be higher and the money demand will shift right. And so is the case with uncertainty. These factors is going to shift money demand. Now, think about supply. As far as supply is concerned, the shape of supply curve for money is a vertical line. We label it as MS. And why is it a vertical line? Because money supply is controlled by the central bank of the country. So, in case in the US, the Fed uses, in conventional sense, there are three tools. Now the Fed has moved on to unconventional monetary policy, but conventionally speaking, there are three tools: required reserve ratio, which is the percentage of reserves that the banks need to hold, that is decided by the Fed. The discount rate, which is if the banks need money, then they can go to Fed and ask for it, and the Fed will charge them discount rate. And open market operations is nothing but the buying and selling of government bonds by the Fed, right? And using these tools, the Fed then decides how much money should be there in the system or economy. Now, why is it a vertical line? Because the Fed makes this decision as a policy decision, and it's not dependent on the interest rate. Keep this in mind that the interest rate do not affect money supply, but money supply definitely affects interest rate. We'll see in an equilibrium. So it's kind of a one-way relationship, which is the central bank of the country decides the amount of money supply, and then that in turn decides the interest rate. And so all these tools will shift money supply, right? So if money supply is higher, that's an expansionary monetary policy. If money supply is lower, that's a contractionary monetary policy. So the central bank of the country can use their policy tools to either expand the money supply, so money supply shifts right, or contract the money supply, so money supply will shift left. And so in equilibrium, money demand is downward sloping, money supply is a vertical line, and the equilibrium is given by this point E naught and M star, right? And this establishes the price of money in equilibrium and the equilibrium amount of money supply and demand. And that's what I was referring to just a while ago, that when the Fed chooses to either increase the money supply or decrease the money supply, expansionary monetary policy or contractionary monetary policy, the interest rate will go down. If it's an expansionary monetary policy, pump more money, price of money goes down. Or if you contract, if you use a contractionary monetary policy, you make money more pricey, then the interest rate will be higher. And so in that sense, monetary policy affects